So we're in week three. This is simultaneously, it feels like this has gone by quickly and gone by very slowly because I count the days, but at the same time, we got a lot of stuff going on. So a lot of stuff to keep up with. So yeah, today we're going to be doing our second part of the book club, and we're going to be doing our week three CPA prep, which is our second CPA prep series. So let's talk a little bit about bad blood. So Mike made jokes about it during the quiz, but bad blood was all about Apple people coming to Theranos and subsequently leaving Theranos very, very quickly. Yeah, started out with talking to Anna Areola, and came on as the chief design officer. And Anna Areola was kind of encouraged by, or was trying to reach out to Avi Tumanian, who is one of Steve Jobs' former confidants, and said, yeah, I'm not sure what's going on. And Avi was on the board of directors, and Avi was trying to figure out what was happening at Theranos. And there was a point of conflict in chapter 3 where Avi had to try to figure out why, or was trying to figure out what was going on with Elizabeth and kind of some of the shenanigans she was up to. And there was a bit of an issue with executive, or with I guess stock options or stock compensation, because in the previous readings, Shanak Roy had basically said, I'm leaving, I'm going to go back to PhD studies. And that's when you know things are bad, is that you're in a corporate position where you've got millions of dollars and said, I would rather just do PhD work. As somebody who's done PhD work, you know, that's where you're saying, okay, yeah, I'm not happy with what I'm doing. So his compensation was basically going to be available. His executive chairs were going to be available to made available to board of directors. But Elizabeth was kind of making the argument they should be distributed all to me. And Avi had said that's a little bit problematic. So it shared some of his information about his concerns with the operations and the revenue contracts that seemingly never materialized, never showed up, and then the revenue projections never fulfilled. So I see a pattern going on here. And Don Lucas, instead of saying, you know, you're absolutely right, we should probably look into this, and said, you know, Avi Tumanian, I don't care that you spent 10 years as one of Silicon Valley's top executives. I don't believe you. All right. So, you know, basically said, I think you should leave the board of directors. Subsequently, he had to sign over his rights to the executive shares. And it wasn't until a lawyer friend of his said, hey, do you really want to be involved in this company even more? It's like, you know what? Yeah, clean break is the best. So I left. And then Anna Areola was kind of saying having some problems with the Tennessee study with Pfizer. I believe it was Pfizer. And she was saying, yeah, I don't know that we're prepared to actually be working on live patients yet. And Elizabeth says, stay in your lane. And Anna decided to just completely change lanes and just got out of there. So then they move on to chapter 4. In chapter 4, there was kind of a big uproar over the devices being sent out. Remember, there was just one of the guys, Aaron, was taken out to doctors' offices to test it and see how it worked. And you're saying, yeah, it's not nearly smooth sailing. It's not just a drop of blood. Often it's several drops of blood. Several drops of blood. They have to take mini pinpricks. But there was a big emergency that happened, and he made a Craigslist ad as a joke. It wasn't a real Craigslist ad. It was a mock Craigslist ad. And it got posted on a wall in the men's room. And then all of a sudden, because something was posted in the men's room, Elizabeth was like saying, this is a real Craigslist ad, corporate espionage. Okay. So got really, really upset in an uproar. My first inclination, if I was in that situation, if I was like saying, is this real? I would go to Craigslist and see if there's an actual Craigslist ad displaying my proprietary technology for sale. That would be my first step, not to gather everybody together and say it's corporate espionage. Okay. But overreaction is always, I guess, one possible type of reaction that you can have in that scenario. And so Elizabeth overreacted. And then, started firing a whole bunch of people in response. And then a couple of the executives at Theranos said, you know what, we think she's driving this company in the ground. Executives, our board of directors, can you please do something about it? And this time the board of directors said, all right, we're taking this seriously now this time. We know Avi Tumanian, we didn't listen to him, but we're going to take it seriously this time. Elizabeth, you're fired. All right, you're fired. Elizabeth said, are you sure? It says, you're right, you're rehired. Okay. So yeah, Elizabeth's back. She fired all the people, suppressor, and okay. After all of that, there's the end of the chapter, and basically saying, all right, we've managed to quell all opposition. I mean, all the Apple folk are gone. That's a problem, I guess. But all the Apple folk are gone. But now it's smooth sailing moving on from here. Okay, but then it stops at the end of the chapter. It says, if they only knew what was about to happen, right? So things get a little bit more divisive moving on from here, which is kind of crazy given how divisive things already are. So yeah, that's where we're at right now. We haven't even seen one of the primary antagonists of the book. I've already alluded to him, but he makes his grand entrance in a big capacity next chapter, so you can look out for that. Trust me when I say that you will have two villains to hate by next week this time. So yeah, two villains to hate, yes. So it's not just going to be Elizabeth Theranos. It's going to also be somebody else. All right, so moving on, we've got some CPA prep to go through. So I had a lot of questions about information and opinions. So should be somewhat familiar with this, but we're going to walk through this and make sure that we have a detailed understanding of what's going on here. And then a task-based simulation that I did not put into the Excel spreadsheet. I think I mentioned a lot of these. A lot of these I actually I drafted into Excel spreadsheets. And when I did this was last year, and I'm using it again this year, although I am updating information. I actually just decided to use the stuff that was on the County Master, but I put it into Excel because it makes it easier to read and I wanted to be able to follow. And I said that, yeah, I would do that for most of these. This one I didn't think was appropriate because there's just a lot of contents in an audit reports and trying to actually determine what the correct opinion should be rendered in this situation. So that's why it's not like that. Trust me when I say that it will follow that pattern moving forward. For most of them, we'll have the TBSs will be in Excel spreadsheets documented. This is just one of the rarities. All right, client's fixed asset experienced a significant impairment loss, but the client refuses to record the impairment loss in the financial statements. Which of the following opinions is an auditor most likely to issue if the amount of loss is material, but not pervasive to the financial statements? So here's the thing, is that we have to evaluate two things here when we're evaluating the opinion. Generally, one of these is the one that we're most responsible for, and that's to actually answer what type of issue is this? Now, let's first of all answer the question, is there an issue with this particular scenario? Is there a problem here? Okay. Is that problem a departure from GAAP, or is it a scope limitation? Departure from GAAP, because there's a misstatement, okay? They're not writing down this significant impairment loss that they should, okay? So we got a departure from GAAP and material statement due to departure from GAAP. So the next question that we often don't have to answer is, what is the severity of this particular problem? Now, as I alluded to, in a lot of scenarios in the CPA exam, you won't have to evaluate the severity. It will just say, choose between the two possible reports. So let's do that right now before we move on to the next part, okay? If we have a problem, it's a departure from GAAP. What are the two types of opinions that we can issue here? Qualified and adverse. Yeah, qualified and adverse, all right? Remember, unmodified. Unmodified would be a clean opinion. That's our unqualified for PCOB. This is a private or a non-issuer audit opinion. Disclaimer opinion or disclaimer of opinion. That would be if there's a scope or a pervasive scope limitation. Okay. So it's going to be either B or C. The question is that what are we looking for to determine and distinguish between B and C? Well, a qualified opinion exists when it's material but not pervasive. Adverse opinion has to be pervasive. And remember, our definition of pervasive is that it's not subject to one area of the financial statements, or if it is limited to one area of the financial statements, represents a significant impact on the client's usage of the financial statements. But it specifically says, is material but not pervasive, so B is our answer. B is the opinion we issue here. All right, I love this company name here, Refrigerators Incorporated. I wonder if that's actually a real company name. If not, I may book it. All right. But changed its estimate for warranty expense from $110 per refrigerator sold in the prior year to $150 per refrigerator sold. This change is properly accounted for and disclosed in the financial statements. The auditor refrigerator should issue a what? So can we agree that there's no reason to issue anything other than a clean opinion here? Are we agreeable on that particular point? All right, so we can issue an unmodified opinion. Now the question is, do we need to have an unmodified opinion just by itself, or an unmodified opinion with the emphasis of matter paragraph? What is going to be our criteria for issuing an emphasis of matter paragraph? That's going to be whether or not the change affects comparability between periods. Now, for the most part, we try to operate according to bright line criteria on this, and we say, from financial perspective, it's something that they account for retroactively, then that would be something that would affect comparability. If it's not something that we can account for retroactively, in many scenarios, we would not have to treat that as a change or affecting comparability. So this one's just a change in warranty expense. So change in accounting estimate. How is that treated from a financial accounting perspective? You all remember that from 303? Yes, prospectively, okay. So logically speaking, unless other information is given, this is not going to be affecting something that affects comparability. Now I want to hold on to that because that actually is going to come up a little bit later. We're going to have to evaluate a similar scenario and we're going to have to determine, does it affect comparability? But in this scenario, absent any other information, we're going to say no. So A is our answer. Not that. That's free. Okay. March CPA is engaged by Monday Corporation, a client, to audit the financial statements of WallCorp. A company that is not March's client. Monday expects to present WAG's audit financial statements with March's auditor to report First Federal Bank to obtain financing in Monday's attempt to purchase Wall. In these circumstances, March's audit report would be usually addressed to. All right. So we've looked at a lot of examples of audit reports. We've talked about this back in week 2, and we looked at the report and the addressee. And I made a specific comment regarding the addressee. In a lot of our scenarios, we said to the shareholders and board of directors, especially for our public companies, okay? But I also made a comment that for our non-public audits, when we talk about addressees, it's not necessarily always going to be the board of directors, or it's not always going to be those charged with governance. Who is going to be our addressee? Then that is contingent on who it was that requested the audit, who it was that employed the auditor to perform the audit, all right? That is our client, and that's the one we're addressing to. Now, when we talk about required audits under PCAOB, this is something that's required under SEC guidelines. So the shareholders and the board of directors are effectively our audience because that's a requirement of being a publicly held company. So we've kind of taken that as naturally a stake. But is it possible that you could have an addressee other than the board of directors or shareholders? Answer is absolutely. Who was the company that engaged us to do the audit? Well, that would say Monday Corporation, the client that engaged March. That would be our addressee in this particular scenario. Okay, so that's A. Block, a CPA firm is finalizing the issue audit of a non-issuer. In drafting an audit report containing an unmodified opinion, how should Block make the following representations of audit opinion compared to financial statements? All right, so this is one of those ones that requires understanding of specific language. Again, I'm not advocating that you memorize the report, but I do think you have to have a good understanding of what detail is included in the report and what information and specific language is included, because this is actually what the key to answering this particular question. So, does the standard audit report, unmodified audit report, talk anything about the consistent application of accounting principles? It's implied, but it's never specifically explicitly stated. Okay, so that's an implicit statement. What about examination evidence on a test basis? Is that phrase used? That phrase is in fact used in both versions of audit report, both PCAOB and the ASB report. So that would be implicit and explicit, which would be A. Okay. All right, an auditor would most likely issue an adverse opinion due to what? So what is going to be our reasons for issuing an adverse opinion? There's only one condition that we can issue an adverse opinion. What is it? Departure from something.
Departure from GAAP is material and pervasive.
Yeah, it has to be a pervasive departure from GAAP. That's got to be our condition for issuing an adverse opinion. So let's go through each of these. Management's refusal to provide written representation. Is that a departure from GAAP? So it sure sounds like it because we're saying, well, they didn't provide necessary information. Are they not providing necessary information for the financial reports, or are they not providing necessary information for the audit? Which one's in the A? A is saying they did not provide necessary information for the audit. That is not a violation of generally accepted accounting principles. That's a violation of GAS. Okay, this would basically be considered a scope limitation, which would be a disclaimer of opinion in that scenario. So A is not our answer. Inadequate disclosure of material information. So what do you guys think? Is that a departure from GAAP? That is definitely a departure from GAAP because remember, GAAP dictates what goes in the financial statements, and if they have to record some information and they fail to do so, they violated generally accepted accounting principles. Let's go through the rest though. Inability to determine the extent or amounts associated with pervasive employee fraud scheme. All right. So we know a fraud scheme exists, but we were not able to obtain sufficient appropriate evidence to determine the scope of that scheme. What does that sound like to you all? Yeah, I use the word scope deliberately there. Yeah. No, it's not just a mouthwash. Yeah, actually, I don't even know if it's still a mouthwash. It used to be called a mouthwash, but yeah. The auditors are unable to obtain the audited financial statements of consolidated investee. That sure also sounds like a scope limitation right there. Okay, so A, C, and D are all scope limitations. This is only one's a departure from GAAP. It's interesting that we talked about that because in 6, in which of the following situations would a disclaimer of opinion be the most appropriate? So as we talked about in previous question 5, disclaimer opinion comes up most frequently when we have a pervasive scope limitation. Now, before I go through this, I do want to talk about one other scenario this might come up, okay? 95 to 99% of the time, you're going to be dealing with pervasive scope limitation. Does anybody remember the other possible scenario where you could have a disclaimer opinion?
External auditors.
Right, the external auditor is not independent from the client. This will never happen in a PCOB or a public company audit. It may happen in a private audit, which really kind of defeats the purpose because the whole goal is to issue that opinion. But if the auditor is not independent from the client, then they can't issue an opinion there. All right, the internal auditor lacks independence. Boy, it sure sounds like that's the correct one. And you're just kind of like saying, I remember auditor, I remember independence, it's gotta be A. What's wrong with that? What's the word that kind of gives us away that it's not the correct answer here? Internal auditor. The internal auditor is not going to be independent from the client because they are the client, okay? They're part of the client. So we would expect the internal auditor to not have independence. There is insufficient disclosure in the notes of the financial statements of reportable segments. Okay, what is this describing? Sure sounds like a departure from GAAP. Does everybody agree with me? One of these days I'm going to say, it sure sounds like, and everybody's going to be like, yeah, it's Friday. I'm just going to nod. I'm just like, you're wrong. Okay, but that is the departure from GAAP this time, yes. The auditor is unable to obtain the audited financial statements of significant subsidiary. That's the same answer as D. Yeah, that's what D. We said D was a disclaimer opinion. Has it changed from this question? No, this is a scope limitation. It's probably going to be our reason for a disclaimer opinion. But financial statements are presented in accordance with a cash basis of accounting. Okay, what do you guys think about that? Is that a departure from GAAP or is that a problem? It depends. Okay, if we're talking about a public company audit, then we'd say, yeah, that's a problem. You have to follow generally accepted accounting principles. But if we're talking about a non-issuer audit, that's fine, okay? They can report on some other basis, specified framework. So C is our answer. Management of Edgington Industries plans to disclose an uncertainty as follows. The company is a defendant in a lawsuit alleging infringement of certain patent rights and claiming damages. Discovery proceedings are in progress. The ultimate outcome of the litigation cannot presently be determined. Accordingly, no provision for any liability that may result upon adjudication has been made in the accompanying financial statements. The auditor is satisfied that sufficient audit evidence supports management assertions about the nature and disclosure of the uncertainty, and the uncertainty is not considered to be unusually important to Edgington. What type of opinion should the auditor express under these circumstances under U.S. auditing standards? Okay, so the question here is, first of all, is there a problem in the scenario? Is there any issue that we can identify as auditors? I mean, obviously, they're in a lawsuit. That's a problem. But with respect to reporting, that's what we're specifically concerned with as auditors. Is there a reporting issue here? No, this is a contingent liability. They treated the contingent liability as they properly should, because they've said that contingent liability exists. They've disclosed it. The only reason they have not accrued for it is because they don't know what the amount is. They cannot properly disclose that amount. When you can't determine the amount, when it's not is not estimable, reasonably estimable, then you just basically disclose it. That's the requirement under GAAP. Which, by the way, you will have to know some financial accounting information for the audit section of the exam. This is one of those examples they like to test on at a contingent liability knowledge. So make sure you have that understanding. So everything's fine. So it's going to be unmodified, but the question is without an emphasis matter paragraph or with an emphasis matter paragraph? So what do y'all think? Do we need to add an emphasis matter paragraph in the scenario? No, we do not. Okay, remember, emphasis matter paragraph comes up if we talk about a report on ICOFR, which is not going to be for a non-issuer entity, going concern, lack of comparability, or some other significant issue, which this is not, okay? So we're going to say A is going to be one of our answers, or going to be our answer here. All right. A former client requests a predecessor auditor to reissue prior year's audit report in connection with the issuance of comparative financial statements by the client. What is the predecessor auditor's responsibility? So predecessor auditor, they performed the audit in the previous year. The client says, look, we're issuing an audit with our new auditor this year. We would like to use your report from the previous year. Can we do so? Predecessor auditor could say yes, but they probably have some responsibilities in that result. So what are some things that they need to do? So review the previous report and make the necessary changes. Are they going to make changes to an already issued report? No. All right. Consult with the client's legal counsel to determine available remedies. That sure sounds like there's a lawsuit involved. That's not, there's no lawsuit. There's nothing going on here. So B is not an answer. Read the current report compared to the previous report and obtain a letter of representation from the successor auditor. Okay. So read the current report compared to the previous report. That sure sounds like legitimate, but then obtain a letter of representation from the successor auditor. What does that mean? It means the successor auditor says, we would like to use your representations in our report this year. Does that sound like something that's reasonable to do? Yeah, in fact, C is our answer, but let's go to D just in case. Audit the current statements. Says, you know what? We know you're a former auditor and we got rid of you for a new auditor, but we still need you to audit the financial statements. Is that cool? We're not going to pay you anything. Yeah, it seems like a little bit extreme. D is not going to be our answer. All right. For each non-issuer company, review the exhibits. Based on your review of the exhibits, determine the appropriate type, opinion type. In addition, determine any appropriate report modifications. Okay. So let's go ahead and let's talk about production gurus. And there's a lot of information associated with this, but so the key areas is going to be exhibit 1, where you have to go into detail talking about what the senior's response to the manager's queries were. And you can see the manager's queries, which this is just necessarily frustrating when we talk about this. Let's see, hold on. Manager's queries, is that actually later in the email? Maybe so. Oh yeah, so later in the email, okay. So the manager said, I saw that production gurus changed his method for depreciation of production equipment. Can you please obtain additional information and document the reason for the change in work April 3315? All right, so we have a change in depreciation method. The audit senior says, per discussion with John Doe CFO, the company changed from straight line depreciation to units of production based on hours of utilization because the company thought this more accurately matched the revenue expense of the machine rather than the straight line method. This is because the company makes revenue with each produced unit. The company accurately accounted for this change prospectively, but it does have a material effect on the comparability of the financial statements. I added this explanation to WP 3315. So all the information we really need to make a decision is listed here. Let's talk really quickly about this. All right. So first of all, they're changing depreciation method. Does the auditor have a responsibility to acknowledge whether or not it's an appropriate change? Yeah, so we're assuming an appropriate change in depreciation method. If the client is just willy-nilly changing depreciation methods because they want to improve their financial position, that is not something that we would consider to be appropriate. That would be a violation or departure from GAAP. It's not what's happening here, but it's something that might come up and something might be need to be aware of. So an appropriate change in depreciation method. What is a depreciation method change? Well, it's a change in accounting principle or a change in accounting estimate may derive from a change in accounting principle. Okay, that was one of those really weird ones when you talk about depreciation methods. So the question is, does it affect comparability? And the answer is, it depends. It really depends on what the circumstances and whether or not that's specified. Now, the thing to note here is if you read in the paragraph, it says it does have a material effect on the comparability of the financial statements, meaning that you can't look at the previous period's financial statements and achieve full comparability with the current period because of this change. So what is our remedy if we're talking about something that affects comparability? What do we have to add to that audit report? That's where we're going to add that emphasis of matter paragraph. Okay. So our opinion here, can we say this is a clean opinion for production gurus? I would say unmodified is fine. Okay, because it's a non-issuer company, unmodified. And report modifications, we're going to add an emphasis of matter paragraph. Okay, because of the reasons that we discussed in the senior's explanation. All right, assisted living group. So let's see what the manager said about assisted living group. Or sorry, production gurus. No, assisted living group. Rugged variance last. Okay, assisted living group. Did you receive the attorney response letter regarding the pending litigation of Friend versus assisted living group? So there's a lawsuit going on. What did the senior say? The senior says, I just received the attorney letter. Based on the attorney response, I believe there's a reasonable possibility of significant material loss related to the case of Friend versus assisted living group. However, no amount can be estimated at this time. All right, so we may need a little bit more information. So let's go ahead and go down, take a look at the exhibit associated with this, okay? All right, so two plaintiffs filed a complaint against the company in Superior Court of Nevada, Friend and Assisted Living Group. A complaint, the plaintiffs have alleged among other things, blah, 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 blah. Plaintiffs seek, among other things, restitution of money paid for services alleged promised to but not received by its facility residents during the period from September year to the present. It is probable that we will lose the case. However, given the uniqueness of the case, we are unable to estimate a loss at this time. All right. So what was our criteria for contingent liabilities again? What were we looking for? We're looking for whether they are probable and reasonably estimable. Do we have at least one of those criteria here? Yes. Okay. So probable is going to be listed, is going to be met. But is it reasonably estimable? No. So what does that mean about the contingent liability? Well, probable and reasonable estimable is our threshold for saying we have to disclose an accrual, or sorry, we have to book an accrual. Our client has to book an accrual. We cannot book an accrual in this scenario because we don't know what that amount of the accrual should be. So the step the client has to make is have to disclose this in the financial statements. Have they done so? Yes, they have. Okay. So if that's the case, have they followed the rules according to this particular scenario, this particular situation? Yes. Okay. So if we go back up, say, what is our opinion type? Do they violate any rules? Nope. So it's going to be unmodified. Okay. And do we have to have any report modifications? Do you guys think any report modifications? No, they have not done anything. There's not anything significant that needs to be disclosed. The lawsuit is already disclosed in the financial statements. So we do not need any modifications. So it's just unmodified, full stop. Red Baron Trucking. Have you ever eat Red Baron pizza when they were kids? Is that still a thing? Yeah, it's what that reminds me of. Have resolved the lease issue. All right. I propose the adjusting journal entry for the capitalization of leases the company is currently expensing as operating leases. It seems like a really old situation. You guys haven't actually had to deal with expensing of operating leases. All operating leases that you all have dealt with in your accounting careers have always been capitalized, correct? It's been a while since I've taught financial accounting, but that rule change occurred back in 2016, I think. So, yeah, a while back. So unfortunately, management is elected not to book the material adjusting entry, is therefore still showing these leases as operating expenses. All right. So basically, let's go ahead and take a look at this. This is, I think, Exhibit 4. So they've got a whole bunch of operating lease commitments, and they book these operating lease commitments in the period. And you will notice that the years that they have booked, they've actually got it in millions of dollars. So 424 million, 560 million, and then 474 million. So it looks like pretty significant, substantial amounts. Now, it's important to note here, even though we have the numbers here, you're still not trying to make a judgment about the severity here. Okay. Again, you do not need to make that distinction. You just need to make the determination of what the nature of this particular type of accounting issue is. So, did they violate the rules? Did Red Baron violate the rules in this scenario? Answer is yes. You can't book operating leases as expenses anymore. That's not something that's allowed by GAAP. Remember, you have to book that stuff on the balance sheet. That's something you had to learn in 303. Yeah. Dr. Shinewan, his smooth jazz voice would tell you, yeah, if it's an operating expense, it still goes on the balance sheet. You know, it's the way it is. Not the way it always used to be. You know, and you hear saxophone music playing in the background. It's a smooth jazz shine. You can tell that I'm in a good mood today because I didn't say anything mean about him. So yeah. All right. So yeah, you do have to actually book the operating leases as on the balance sheet. So what do we call that when you don't follow the rules? A departure from GAAP. All right, there we go. I just saw GAAP there, so I say. So we have departure from GAAP. All right. Departure from GAAP is going to be one of two opinion types. Which types? Qualified or adverse. Okay. Do we need to make that distinction here? So if you look at the dollar amounts, can you make the distinction of whether this is material versus pervasive? Those are large dollar amounts. You might want to say, well, they're pervasive, but we don't know this the context of the scenario. So answer is we don't know. Okay. So we're just going to say right now it's going to be material, or it's going to be qualified or adverse, one of the two. We haven't made that distinction. What are the report modifications in this scenario? All right. So let's go ahead and talk a little quickly about this. All right. The report modifications for both types of reports. We're going to have to modify, obviously, what section of the report. The very first modification we make is going to be in the opinion section, because we have to actually say the financial statements are either, except for one item, are free from material misstatement. We have to add that except for, or we have to add financial statements are materially misstated or not free from material misstatement. So the opinion is going to be modified regardless. Whenever there's something other than an unmodified opinion, what else do we have to do? We have to change the basis for opinion section. We have to add a paragraph saying, hey, here's the reason that we have this change in opinion. You should probably know about this. Yeah, they're expensing cap or the expensing operating leases because they're still in 2016. Yeah. So that's something we have to figure out. All right. So modify the opinion section, modify the basis for opinion section. I do want to talk about one more possible scenario. Okay. Let's assume that they're reporting on key audit matters naturally. and this is an adverse opinion, okay? So again, key audit matter section is not always included in the private issue report, but if they had previously issued key audit matters and they issued an adverse opinion, would there be another change that we'd have to make? This would not be included on the CPA exam, by the way, but I'm just trying to reinforce this. So remember, critical audit matters gets removed when we talked about extreme opinions, so adverse and disclaimer opinion. The same holds true when we talk about the non-issuer audit opinions. Key audit matters go away whenever you have adverse or disclaimer opinion. Okay, so in the case of extreme opinions, you remove the CAMs, whether with that with C or a K, they will go away. Okay. All right, and that does it. Hopefully you guys did pretty well in this. Again, there will be, from my experience with talking to students on the audit section of the exam, there is quite a heavy emphasis on audit reports. Keep in mind that their emphasis is more likely to be on the private or the non-issuer version of the audit reports, because you are taking an exam that's administered by the ACCT, so they're going to be more interested in their information than the stuff that's issued by the PCAOB. So that should be a focus of your attention. All right, with that, I will see you all on Monday. Please keep in mind that you need to complete the entire assignment before class on Monday. Okay, we do not have class on Wednesday because of the FBLA event.